which leads us into the next little piece. Now, folks, not all of this, but the next part that I'm about to get into in the financing, it's going to be a lot like the land use control section. Bunch of vocab, all right? Flashcard level stuff. Not in depth, not detailed, not analytical, flashcard level. Just recall what it is. It's really the best way to put it. So here's where we get into the flashcard level, the other types of loans, if you will. This is basically just miscellaneous loan structure, loan payment style, things of that nature. Graduated payments. Cheyenne, does that mean that you're back?
Good to go. Yeah, sorry, we use it at work. It's like good to go.
So I've always read that as got to go, and then you don't leave, and I'm like, well, it obviously does not mean got to go, because she's still here. So I just thought that this time, after seeing it for so many nights, I would ask. So, yeah, see, I got to go. I thought she was leaving, and then she stayed, right? So, I don't know. All right, now we know. She's good to go. There you go. Graduated payments. We're going to talk about this in leases too down the way. But a graduated payment would be some type of loan structure where it starts at a certain interval and then it would increase at other stated intervals. So it could be something that increases every year, every 5 years. And, you know, the whole point is it would just pay it off faster. So it could be like $2,000 a month for the first 5 years and then $2,500 for the next 5 years. That's all it is. It graduates, right? It's a step up at intervals. There's no one size fits all. Just fixed amount, and then it goes up, and then it goes up based on pre-stated intervals. There's reasons for this. Don't get so caught up on that. Just know what this is. This is all flashcard level. A package loan, folks, includes real and personal property. And I want you to think of package in a certain way. If you were to order 6 things from Amazon right now, no matter what they are, what is Amazon probably going to do when they send them to you? Package them, Tara? Package them. Tara said, package them together. I like it. Package them together. I like the miming. It's like charades. All right, y'all don't talk to me, but we play charades. We have fun. I like it. I'm here for games. Yeah, they're going to package them together. And so that's what I want you to think of it like a package loan. It's multiple things packaged together. Now, just like I said, with Amazon, it doesn't have to be the same thing. You could get hair care products and cat food. They're still going to put them in the same box. They're not the same thing. And so that's kind of the same thing here. A package loan is a loan that would bundle together both real property and personal property simultaneously. Why is this unique? Because if you're buying a house, the banks don't like for you to include any personal property above refrigerator, washer, and dryer. Why? Because they can't put a lien on your personal property. So they don't like to give you value for personal property. But this type of loan takes into consideration personal property and gives it value and would be part of the agreement. What would you use this for? Buying land and a manufactured home at the same time, right? Because if it's still personal property, then you've got your real and your personal. This could also be used for buying a fully furnished Airbnb. If it's fully furnished and it's got $60,000 worth of furniture in there, they've got to give it some value, right? So this would be a unique loan that takes into consideration the value of both the personal property that's being conveyed as well as the real property simultaneously, called a package loan. The next one, which conceptually is kind of similar, but there's a key difference, is called a blanket mortgage. Folks, I want you to think about going into your living room, and hopefully you can relate with me here, and you pick up the biggest, snuggliest blanket that you own, and you toss it in your living room, okay? As long as you have a decently big and snuggly blanket, it's probably going to cover multiple areas of your living room. That's what a blanket mortgage is. It is a loan designed to cover multiple parcels of land. Yet again, very common with developers. If I had a person who owned land on this side of the street and a person who owned land on this side of the street, and they're very close proximity, and I'm a developer, I may get one loan called a blanket mortgage to buy lot A and lot B from both these sellers at the same time. Or maybe it's the same owner. But what it does is it treats both those pieces of property as collateral. One loan, both are collateral. So that way I don't have to get two different pieces of financing. So very common with developers, also common with builders who will do takedowns of lots. So if we had a neighborhood developed, like a cul-de-sac, and we had all these lots, a builder will very commonly take a blanket mortgage, excuse me, and purchase 10 lots at one time, as opposed to getting a loan for each lot. Bree says, do you get a better rate? Arguably, your rate already kind of sucks because it's a commercial loan, but probably. Because they have more collateral. So, blanket mortgage covers multiple pieces of property. Package loan covers real property and personal. Make sure you keep those straight. Growing equity, not too dissimilar from a graduated structure. Loan in which payments increase annually, applying additional amounts to the principal and then shortening the loan term. Yet again, some people will design it where it'll be paid off earlier. You could even arguably do this of your own accord. They say if you make an extra payment, you will pay your house off faster because your principal balance goes down faster. Now, it doesn't quite go as fast as what a lot of the people will tell you it does. But a growing equity loan is just one where you're designed to increase your payment, even though it's not required to go up. And what it increases by is paying down your principal even faster. So your equity grows faster because principal decreases. Remember, that's what we said. Debt service going down means equity goes up. So it's called a growing equity loan. Now, one of the arguably more testable ones is a construction loan. And I'm sure you are all familiar in some way, shape, or form with a construction loan, but what you may or may not realize is exactly how it works. There's two types of construction loans. There is the one that the builder will get to build your house, and then they turn around and they sell the house to you, and you'll get a traditional mortgage, and then they'll pay off their construction loan. There is also a construction loan that a consumer can get, and that will eventually turn into a fully amortized fixed rate loan. But let me tell you the unique thing about construction loans. Let's say that you were approved for let's just say $600,000 construction loan. If the bank was to give you $600,000 right now, what are you going to end up doing? Spend it, God, I hope not, on something other than your house. But what is the bank going to expect you to do? Begin paying interest on all $600,000. Folks, how long on average do you think it takes to build a house? Months to years. There you go. 6 to 12 months, I would say, is a pretty good guess. Y'all are all kind of hitting right on it. 6 to 12 months. And I want you to understand what that means. If the bank was to give you $600,000, you're going to be paying interest on $600,000. But folks, you don't need $600,000 yet because houses are not built overnight. And so these are designed to utilize what's called draws. You get approved for $600,000. But then they will give you draws as you need them. You may need $40,000 to close on the land. You may need another $3,000 for, surveying. You may need, another $4,000 for grading and $15,000 for foundation, $80,000 for framing. You're only going to take it out as you need it. So that way you're not getting charged interest on money that you're not borrowing. So these are done in draws. That's what they're called, making these draws as you need them. And so if you were a consumer doing this and paying your general contractor with these draws, what would happen is when you make the final payment and the house is done, then the bank would convert it to a fully amortized fixed rate loan. And in a lot of instances, you're paying interest only. You're doing a term or straight loan in the time you have construction, where you're just paying the bank the interest for the 6 to 12 months that they're lending you the money on the amount that you borrowed thus far. So that is the unique thing about a construction loan. You're not getting the whole amount up front. Even though you're approved, you would take it out in draws as you needed it, so you didn't pay so much interest. Now, of course, a builder will get a loan much like this as well when they're building a property for somebody. But the difference is the builder's is never going to be turned into a standard amortized fixed rate loan. What happens is when the builder is done building the house, the consumer will get a standard fully amortized fixed rate loan, pay the builder everything they're owed. The builder takes that money to pay off their loan and then keeps the rest as profit. Now, the other one on this sheet is called the sale and leaseback. There's a couple times where this commonly happens. One is investors and one is builders. If you ever go to a new construction community and they have a model home, the model home is typically the first or second house in the community. They want it up near the front, so it's easy to find. It's not always there, but very commonly. But the houses at the front of the neighborhood are not as popular. A lot of times people don't like to be right there on the street. And so what they'll do is not long after they finish the model home, as they start building in the subdivision, they will actually market the model home for sale, even though they're using it as their sales office. What they're going to do is they're going to negotiate with a buyer who will purchase this model home, close on it, and then the builder will lease it back from the person who bought it. That allows them to already have that home sold. And then they will eventually, when they get done, they'll terminate the lease and they'll leave, and then the person will move into it. Brooks says you don't want those homes. Why do you say that, Brooks?
Those model homes are built at such an accelerated rate that sometimes corners are cut more often than they would with a standard home, because I know for a fact that a lot of larger builders can actually get a model home up in less than 2 months.
Yep.
Where a standard home takes between 3 to 5 months.
Yep, there you go. Very true. That is very true. Not always the case, right, with anything, but it is something that can happen. And, truth to be told, even the ones they spend 6 months on, there are some builders that are just, and subcontractors that are so shoddy, you could be dealing with it then. But that's a valid point. It could be a big considering factor. You could also have drainage issues because everything wasn't graded out, whenever it was done, because it was in the front of the neighborhood and everything's being built around it. There are some reasons. You're absolutely right. I'll tell you the other time that a sale and leaseback is exceptionally common, and I've seen this in corporate America several times in my career. It is not uncommon for big businesses to own real estate. I worked for a brokerage firm one time that owned a big commercial building in Cary, and the building was probably worth $10 million or something like that. Maybe it was more than that. And they owned the building. But what they did is they marketed it for sale to an investor. And so what will happen is an investor will come in and they will buy this building from somebody who owns it. But because the person who owns it wants to still use it for business purposes, they will negotiate a sale and leaseback. What does that do? That gives them free capital of $10 million. Now the business gets the $10 million from selling the property for them to use right here, right now, and they get to continue operating in that business by signing a 10-year lease. That'll say, hey, we're going to rent it back from you for the next 10 years. And it's very common for businesses to do this for freeing up capital for expansions, for projects, for, downturns, a lot of different things that they'll do that for. So that would be a sale and leaseback. Now, several more here, and as I said, these are all flashcard level, so don't get so crazy on them. I mean, a lot of these you could really kind of guess what they are just based on the name. The names are not too far off from what they actually do. And so this one's called a reverse annuity mortgage. A lot of times it's just called a reverse mortgage. And so in a typical mortgage, folks, you are making monthly payments to the bank to pay down the principal balance plus interest that you owe them. A reverse mortgage is the opposite. The banks pay you monthly payments. Why do they do that? Because you have so much equity in the house or the house is paid off. This is a very common retirement vessel. And so what people will do later in life is if they own a home that they don't really care about leaving it to anybody, or they don't have anybody to leave it to, they will do a reverse mortgage where the banks will basically just give them monthly living expenses, $2,000 a month, $3,000 a month to live on. And as they're lending it, you are building up a principal balance that will eventually have to be paid plus interest. And so in a lot of instances, the interest gets tacked on. And then if somebody does this as a retirement plan, when they die, the house will be sold, the banks will get their money. This is not a good idea for somebody to do if the house is sentimental, if they intend to leave it to somebody, because this has to be paid off. So if somebody borrows $200,000 against the house that was paid off, if somebody in the family wants to keep it, they've got to pay off that $200,000 plus interest. So it does have a time and a place, but it is very risky if that's not your plan, right? If your plan is not to let the banks just sell it off and, anything that's left go into your family, you need to consult somebody. But it could be useful in your elderly years, depending on your situation. You look like you have something, Beverly.
Yeah. So at the end of that reverse mortgage, say someone wanted to, wow, my battery's dying. Say someone wanted to pay off that balance. Can it be financed, or do they have to come to the table with everything at that time?
No, it can be financed just like anything else. You could potentially get a loan to buy the property, and that property you would basically then pay off that balance, and then okay. Yeah, that's absolutely something that you can do. You just want to make sure that there's enough equity there that the banks were not going to have a problem with it. Yeah.
Okay.
Mm-hmm.
I'm kind of confused. So
Yeah.
in this reverse, they're paying the borrower, but the borrower still owes on the house.
No, a lot of times the house is either paid off or they have a lot of equity. So they're never going to give you more than what you have in equity. So, let's say that your grandmother owns her house and she only owes $100,000 on her house, but her house is worth $600,000. She could be getting, a $4,000 a month payment from a reverse mortgage while she's making only a $700 a month payment to her actual mortgage, because at the end of the day, they're going to calculate it where at the end of it all, they're not going to give her more than what she has in equity, so it can be paid off. So this is very common when the house is either paid off or you have a lot of equity, and so both could be possible.
Okay, and what is the bank doing by keeping? Because normally, okay, when you finish paying for a house, the mortgage, the loan's over, it closes, right?
Well, yeah, I mean, you wouldn't say yeah, the loan closes and they would record the satisfaction of the deed of trust and you would get the full ownership of the house. The bank would be gone.
Right, the bank would be gone. But in this case, the bank is staying around. Is that what this is?
The bank is basically, think of it this way, and let me just give you a comparison for you to understand. If the house is paid off, you own your house scot-free right now, Bree, and the bank starts paying you in your retirement years $3,000 a month, you're going to, every single month you get it, you're actually accruing a balance as opposed to paying off a balance. And so let's say that, you do this for, 10 years. 10 times 12 times 3,000. You've accrued $360,000 plus interest. If your house is worth $500,000, what happens is when you die, they're going to sell the house for $500,000. They're going to get their $360,000 plus interest, and then if there's anything left, it would go to your estate. That's how this works. They're not going to disappear until you die and the house is sold, or until you cap and sell the house to pay it back. You don't have to die. You could just end up, saying it's going to do it for 10 years and I'll sell the house and pay you back and move into a retirement facility.
Okay.
Yeah. So instead of taking a lump sum from the bank to buy a house, it's the opposite. They're giving you money each month that will eventually result in them being owed a lump sum. Now, let me explain the buy downs here, because this is kind of an interesting thing. This is not too dissimilar from discount points in some ways, but it's very different in others. And this is very common in the market right now. Buy downs are when the seller, a lot of builders are doing this, sometimes the individual homeowners do this, will offer money to buy down the initial interest rate for a year or 2 or 3 for the borrower. And so because it's not buying it down for the life of the loan, it is a lot cheaper than discount points, because discount points are for the life of the loan. So you can typically buy down the interest rate, by a couple percent for the first year, 1% for the second year, things of that nature for several $1,000s, because you're basically prepaying interest for the first few years. Why would they do this? It makes the house more enticing for a buyer when the interest rates are higher. And what buyers get is this lower interest rate for a few years, hoping that at that time they could potentially refinance before it goes up to, a rate that maybe they're not as comfortable with. So there's a lot of builders doing this right now where they're buying it down for, I think I've seen like 3.9% for the first year, 4.9% for the second year, and then it goes up to 5.9 and stays there at year 3. But you do have that lower interest rate for the first 2 years because they're buying it down. So that would be a buy down. It's a fixed period of time, not for the life of the loan like a discount point. The next one in the vocab list is a bridge loan. Folks, what does a bridge do? Not our friend Bridge who is in the class, right? Spelled differently. Not bridge, a normal bridge. What does a bridge do? Gets you over something. Connects you from one side to another. Yeah, link some things together. There you go. I like that. Connect you from one side to the other. Link some things together. Yeah, folks, that's exactly what a bridge does. I was expecting some charades, Tara. You let me down. Okay, I was expecting Tara to be like something like that. That's what I was expecting, Tara. Come on, step it up. Let me down on that. So a bridge loan, folks, does exactly that. A bridge loan, yeah, Brad says like having 2 mortgages for a short period of time. That's exactly what it is. Yet again, because you have so much equity in a house, you could potentially borrow money from your current house to get a lump sum to use as a down payment on your next house. And that could potentially allow you to close on your next house before you sell your other one. So these are not long-term loans. They are typically higher interest rates, and they're designed to be for short-term periods of time so that you could bridge going from one house to the next house. And so once you move, you sell your old house, pay off the bridge loan, and you've, got your other standard homeowner's loan or the other, standard loan that you was your secondary one after you paid for the down payment with this bridge loan. Beverly says, are these commonly utilized? Yeah, not uncommon in any way, shape, or form. Some people will not use a bridge loan. They'll do a home equity line of credit, and they'll use it like a bridge loan. So if you've got, an $80,000 home equity line of credit, you could just basically pay $80,000 down payment with that and then pay it off when you sold your house. So some people will use HELOCs in the same way, but a bridge loan is not uncommon. Now, the problem, though, with the bridge loans is they're not common in the sense that there's going to be a lot of debt to income ratio calculations because you've got your old loan, you've got a new loan, and you've got a secondary lien on for this bridge loan. And so it may be that, a lot of buyers may not qualify to do this because most will not qualify to carry 2 mortgages simultaneously. And so that's why some people can and can't do this. It just depends. Because if you've got a $3,000 home loan, your new house is going to be a $4,000 home loan. That's a lot of debt to income ratio that they're considering, and they may not qualify you even though your intention is to sell off the other one. So it could be one of those things. But yeah, it's not uncommon. So we are rocking and rolling in the loan discussions, just the vocab style things, right? Just the different ways that you could be paying, different ways that you could borrow, more unique things, if you will, than anything. And as I said, you're just going to have to be able to identify these on the test. It's not going to be anything super in depth. No crazy differentiation aside from keeping these straight from each other. And so we left off on bridge loans. And it's kind of a short-term loan designed to bridge you from one thing to the next. Most commonly utilized, as we said, from selling one home before you sell it, borrowing money against it to use as a down payment on the next home. Sometimes utilized to maybe fund the purchase of a piece of land in the interim of getting the full-fledged construction loan, things of that nature. But that's really what it's designed to do. They're short-term, so they're a little bit higher interest compared to a standard loan. Now, one of the reminder as we're sitting here talking about loans, I'm sorry, Janet, what you got? Oh, is that an accident? Are you talking? No, what, huh?
Oh, there we go.
Yeah.
Can you hear me?
Yeah, now I can hear you.
I said, well, this work kind of, if you want to do like flip homes.
I mean, if you were flipping a home, you could potentially access equity in your current home to do this, but, of course, you're going to be borrowing against your own property to flip another property, so it would just be something that you'd want to be very clear about with your lender, what your intentions were. I'm not going to say that you couldn't use it for that. It's not really designed for that, but in theory, maybe. So, when we've been talking about liens, folks, when you're borrowing money, there is going to be liens put against the property to ensure that these individual people get paid. And so those liens are the security instruments, as we said. And when we're talking about these liens, of course, first recorded, first in line, right? That's what we've always said. First recorded, first in line. And then, of course, there are some mortgage liens that are some things that are not mortgage liens that would be more superior, like the real property taxes and the special assessments, as we've talked about. But what you have to understand is sometimes, and you don't really need to understand why, sometimes banks will decide to change the order. So, in other words, there may be a lien that's recorded second, but for whatever reason, the lending institution wants that one to become the first in line. And so the way that they would do that, because it's being recorded second, is they would file what's called a subordination agreement. That is basically where the person who's in lien position number one agrees to sit in position number two. Yet again, you don't really need to know why they would do that, but if we were talking about a means in which they would subordinate or be put in a second position after one that was recorded after them, that would be a subordination agreement. And so the one in the highest priority position is called the senior mortgage versus the secondary positions would be referred to as a junior. And as we said, you can change the order with that subordination agreement. Now, with all this mortgage talk and lending and financing, even though I've introduced a lot of new concepts, even though I've introduced a lot of interesting things, there's at least some familiarity with this side of things. People buy homes, people borrow money to, get the homes, that there's different loan types. And so all that kind of makes sense. The other side is something that you may be a little less familiar with, and we don't need to go into a crazy amount of detail on it. It's just to have a general understanding of exactly how it works, or kind of how it works in the real estate industry. And so that is what we would call the role of the Fed and the role of the secondary mortgage market versus the primary mortgage market. So the Federal Reserve System, more commonly referred to as the Fed, their job is to maintain sound credit conditions and combat inflationary and deflationary trends, try to stabilize the economy. And of course, when we see the economy go down or up and, we're in a recession, a depression, or anything like that, the Fed tries to help. And the way they do that is by adjusting the amount of money in the economy, lowering interest rates, raising interest rates, things of that nature. And so, if you didn't know this, folks, banks do not print money, okay? The Federal Reserve prints money, and banks borrow money from the Federal Reserve. And so I've kind of used this comparison before. If you were to lend somebody $5 and that's all you had in your pocket, and then somebody else asks you to borrow money, you don't have anything left to lend until somebody pays you back that $5. Banks work the exact same way. Banks borrow money from the Fed at a cheaper rate than what they lend it to us as the consumers. It's just like anything in our economy, folks. There are the people who manufacture equipment. If you think of like a car manufacturing plant, they manufacture the cars at a certain cost. They sell those cars at this cost to the sellers, right? The people who are the retail stores, and then they sell them for a markup. That's how this works, right? This middleman exchange. Money works the same way. The banks borrow it for a lesser rate, and then they turn around and lend it to us for a higher rate. And so when we pay them interest, we're paying more than what they owe the Fed. But they are capped at how much they can borrow from the Fed, just like anybody would be. And of course, it's more complex than what we really need to get into in this class, but that's it in a nutshell. And so the other two components that I mentioned are the primary mortgage market and the secondary mortgage market. The primary mortgage market you are familiar with. It is the banks lending money to consumers to buy real estate. If you wanted to go buy a house today, you would be partaking in the primary mortgage market. The secondary mortgage market, we'll get into more in detail in just a second, but it's basically where these loans are sold off to free up capital for the banks to continue lending. Because I told you, even banks run out of money, just like anybody else would. And so the way that they get money back is by selling off these loans. So the primary mortgage market consists of the banks who originate the loans. It also consists of mortgage brokers. Now, do not get confused. Those are not the same thing. What did we say a broker was very early on in class? Not an agent. There you go, Bree. A broker brings two parties together. And so we're called real estate brokers because we bring together two people in a real estate transaction. Mortgage brokers are not the lenders. Mortgage brokers bring together the banks who want to borrow money. The borrowers who want to borrow money and the banks who want to lend it. That is what a mortgage broker does. And so if you've ever heard like Lending Trees commercial, it's like when banks compete, you win. And so mortgage brokers bring together the parties. They're not the lenders. But they are still part of the primary mortgage market because they help facilitate these loans coming to play. And of course, the way that the banks who lend the money make money is through the interest they charge, of course, origination fees, loan servicing fees, finance charges, and everything in between. And so they make some money up front, and then the vast majority of the money is made over time on this interest. But I told you, not every bank will hold on to their loans forever. A lot of them will sell them off. Folks, if they lend out $2,000, but they're owed interest, the face value I told you in some of the examples we looked at could be $400,000, $500,000. And so what they'll do a lot of times is they'll turn around and take this IOU that has a face value of $400,000 and they'll sell it to another bank for $350,000. Why? Because they made a crap ton of money right then, right there. And the other bank is going to benefit by just sitting on it by making an additional $50,000 versus what they paid for it. So they're going to make money by sitting on it. So this happens all the time where it gets sold off. Now, that's really what it comes down to. Now, sometimes the banks will sell it to other banks. Sometimes they will sell it to the quasi-governmental agencies. And I told you, folks, one of you asked me in this class many weeks ago how I felt about Prep Agent. I said it's fine for national content. And I told you that there was even a video that I was going to show you because it does do a good job of explaining this in a way that I kind of like. So I'm going to show you a video just so you can kind of understand the secondary mortgage market a little bit and why it came to be as it is. Do you need to know it to this extent? No. But is this very informative? Yes. And it kind of helps give you a better grasp on it. So the whole reason this secondary mortgage market exists is because of the way that lending has evolved over time. They were having trouble ensuring that there was money to continue lending, and so these quasi-governmental agencies were developed. And of course, they purchase these loans to free up capital for the banks to keep on lending. And it's really funny if you think about it, because Fannie Mae was actually the Federal National Mortgage Association, which is FNMA. And they're like, well, that sounds too governmenty. Let's give it a name so it sounds a little less hostile. And so I'm assuming they could really just come up with it based on the letters, right? FNMA. So they're like Fannie Mae. We'll call it Fannie Mae. And then same thing with Ginnie Mae, right? It was the Government National Mortgage Association. So it kind of looked like Ginnie Mae. So they call it Ginnie Mae. And then don't even get started on Freddie Mac. One thing that you may need to know, Fannie Mae purchases conventional FHA and VA, all three of the big loans that go out. Ginnie Mae, because it's Government National Mortgage Association, of course, buys only the government-backed loans, FHA and VA. And then Freddie Mac purchases conventional only. And I told you earlier that the underwriting guidelines have to be met. And so when I talk about underwriting guidelines, I told you, think of it kind of like a recipe that they've concocted of what a loan needs to be comprised of. These debt to income ratios, these minimum credit scores, these, work histories, the, equity in the house versus the price and the lending. So they have all these different criteria, and they have to conform to these criteria for these governmental agencies and secondary people to want to buy them. And if they don't, they will not be purchased. That'd be a non-conforming loan. And of course, non-conforming loans are a much higher risk because that means the lender has to maintain them for the duration. Now, all the things that go into these underwriting guidelines, I just named some, folks. There's a lot of considerations. There is is anybody still looking at that? Some of you look disappointed when I switch slides. Are you still looking? Yeah? Still looking at this one? Bree says yes. Okay. All right. One of the Brees said yes. Yeah, there's two of you. Okay. There's two Brees. I'll leave that up for a second. Now, I will tell you that what's about to come down the pipeline is more math. Okay. I know y'all are excited about that. Okay, I know this. Don't look at me like that, Anthony. Okay, listen. Okay, yeah, your face is right there. I see it. Okay. It's not secret. Your face is not on mute. I'll tell you that right now. Okay, just because you are, your face is not. I can hear it loud and clear. Okay? She's like, man, I'm going to slap this, man. Don't you do it. I'm sensitive. You might make me cry. So, we're going to talk about math. Now, folks, it's not overly difficult math in and of itself, but it is abstract math, and so you're not going to like it. And I will tell you that while the initial math is pretty straightforward, there is a subsidy of this math that I'm about to introduce that is so bad, so terrible. I'm not going to teach it to you tonight, but it is hands down the worst math concept in the entire class, in my opinion. And I can kind of show you an example of what I'm talking about, but I'm not going to teach it to you. And I took it off my test because I thought it was just cruel and unusual more than anything. But, it's still arguably testable. So when we're talking about loan criteria and underwriting guidelines, there's a lot of things that are considered for a borrower, right? Credit characteristics, their credit scores, credit history, of course, adequacy of assets to close on the transaction, meaning do they have the cash to bring to closing? Do they have enough to make the payments? For any inspections and things of that nature. Of course, the stability of their income. And so what we like to see is about 2 years of job history of the same job. That's in general what they look for. Now, they will consider same job title, but different companies if there's no lapse in time as okay. But if you change jobs, you've been there somewhere less than 2 years, they consider you a higher risk. You're probably not going to meet typical financing. And of course, they also only consider, acceptable income. And so, jobs that you've been doing for 2 years, things that are reported to the IRS. Of course, if you're not claiming it and it's mattress money, they can't conclude that because they don't know where it came from. And the other things that come into play is, of course, the debt-income ratios of the consumer. So we're going to get to the debt-income ratios in just a second. And that's where I'm going to teach you the math. I just want you to understand. Also, folks, let me clarify one other thing. Your amount of money you make, and more specifically your debt-to-income ratios, will dictate how much house you can afford. Your credit scores, you typically have to have minimum credit scores to be able to qualify for certain loan types. And of course, the better the credit score, the better the interest rate you can get, arguably is the way that it goes. So both numbers are equally important in their own right, because you could have an amazing credit score, but if you're not making any money, you're not going to qualify, and vice versa. You could be making a lot of money, but if you have a terrible credit score, you also may not qualify. And so all of these come into play. So we're going to get there. Before we get there, folks, and actually, let me just make sure that I'm like not crazy, because I want to. You know what? I'm not crazy. That's right there is where we're going to do it. Okay. So before we get to the math, which I know you're so excited about, let me introduce something that's even arguably, it's not worse, but it's just annoying, folks. There is a big testable aspect of the financing chapter that deals with financing legislation, lending laws. And there's a lot of them. And this is, once again, one of those moments where certain things are going to come full circle. Because I've introduced terms earlier on in the class that you didn't know what they were yet. I kind of gave you some insight into them, but you didn't know what they were yet. And one of those is RESPA, the Real Estate Settlement Procedures Act. But before I explain that, let's just go back a little bit, folks. I just mentioned not that long ago the housing market crisis of 2007, 2008, 2009. And so there were some really bad things that happened in that time frame. And here's the best way I can describe it. Have you ever seen the meme online where you've got 3 different Spider-Men and they're pointing at each other? Ashley A nodded her head. Ashley D, you said yeah too. Yeah, of course. Anthony. Yeah, a lot of you have seen the meme, and of course that came to pass in the new Spider-Man movie. Spoiler alert. But the meme where the 3 Spider-Men are pointing at each other is the best way that I can explain what happened in the housing market crisis of 2007 to 2010. Why? Because the lenders were pointing their fingers at the real estate agents. The real estate agents were pointing their fingers at the lenders. The lenders were also pointing their fingers at the appraisers. And so it was basically the lenders, the real estate agents, and the appraisers all pointing fingers at each other. And so things went horribly awry because banks would give anybody who had a pulse a loan back then. Oh, you're making $725 at McDonald's? Sure, you can buy a $700,000 house. Sign here on the dotted line, right? Oh, your cat, has an identification card. We'll give them a loan. I mean, it was bad. They gave anybody and everybody a loan back then that did not qualify. The other thing that was really bad was real estate brokers were able to pick up their phone and call their favorite appraiser and say, hey, they're buying this house for $600,000. I needed to appraise for $600,000. And appraisers would do it. And so, of course, when all of these things were happening where the lenders weren't doing things right, the real estate agents weren't doing them right, the appraisers weren't doing them right, that led to what we call subprime lending. People getting loans and being in situations that they cannot afford, they shouldn't have been in. And there was plenty of well-qualified buyers, folks, but the problem was there were so many non-qualified buyers that they kept letting their houses go. There are so many foreclosures and short sales, and when that happens in a neighborhood, it drives down the values of all the other houses. So even people who were well-qualified buyers and could afford their houses now were upside down because their values plummeted when all their neighbors got foreclosed upon. It was a mess. And people didn't really believe in houses anymore. If you want to know the easiest way to be a billionaire today, it's figure out a way to go back in time to 2007 and buy as many foreclosures as you can, and you will be a billionaire today. But shoulda, woulda, coulda. And so what the government kind of realized is that people lost faith in the housing market, and that's one of the main ways the banks make money. It's one of the main ways that the Fed makes money from lending to banks, which are some of the largest lending institutions next to credit card companies. And so they passed a really big piece of legislative reform called the Dodd-Frank Act. Okay, it's called the Dodd-Frank Act in 2010. Now, Dodd and Frank were people, not important. You don't need to know exactly how that came to pass. But one of the biggest things that the Dodd-Frank Act did was it created the CFPB, the Consumer Financial Protection Bureau. And I'm sure you probably heard of them, but you probably didn't realize that they're only have been around as recently as 2010. They did not exist before that, which is crazy to think about, because that was only 14 years ago. And so the CFPB, the Consumer Financial Protection Bureau, now became the oversight agency to protect consumers in certain financial capacities. And it became the oversight agency for several different federal agencies, including the Fed, including the Department of Housing and Urban Development, and the FTC, which is the Federal Trade Commission, just to name a few. So they're kind of overseeing a lot of other government entities to ensure that certain things happen. Of course, they also enforce certain regulations for the banks, the lending institutions, the mortgage brokers, and administer laws. Now, here's kind of the interesting thing, folks. And I say interesting, not as in it's actually interesting to you. This is just necessary evil crap. But it is interesting if you care. There was 2 pieces of financing legislation that existed since the 70s. And one of those was RESPA, which is the Real Estate Settlement Procedures Act. And the other one was TILA, which is the Truth in Lending Act. But while they've existed since the 70s, folks, there was nobody enforcing them. Here's the question for you. If you saw a speed limit sign, but somebody told you with absolute certainty that there was no cops monitoring your speed ever, are you going to drive the speed limit? Most of you said no. Probably not. And that's exactly what happened with the banks. They realized nobody gave a crap about those laws, so while these laws existed, nobody was enforcing them, so they weren't adhering to them. So what happened was, once the CFPB was created, they started administering and enforcing RESPA and TILA. And they even tweaked some of it and added some things to it. Now, those are going to be some of the very testable aspects of the financing legislation, understanding RESPA and understanding TILA. Now, understand that knowing the name is half the battle. Okay, I want you to think about this as you look right here on this slide before I switch over. Real Estate Settlement Procedures Act. RESPA deals with real estate transactions. And so the whole purpose of RESPA was to provide full disclosure of all costs associated with purchasing certain types of real estate. Because, folks, if I told you that you're buying a house for $500,000 today at a 6% interest rate, do any of you know what that's actually going to cost you right here, right now at closing? And do any of you know what it's going to cost you over the life of the loan? The answer is no. And so the whole purpose is to help you understand what you're really getting yourself into when you sign on the dotted line to commit to pay for 30 years. Now, the Truth in Lending Act deals with all lending, right? Credit cards and car loans and personal loans. It's just disclosures of all costs associated with borrowing money. So consumers can make more educated decisions in borrowing money. That's what this comes down to.